My name is Thia Hennessy. I'm an economist, head of the Agricultural Economics Department in Teagasc, and I'm based in Athenry, County Galway. I'm going to talk about the macroeconomic outlook in general and how it affects the agri-food sector in Ireland, and then talk about farm income. So in terms of the macroeconomic outlook, just to think briefly about how that's affected the agri-food sector this year, the two major developments have been exchange rates and oil prices. The euro has been very weak throughout the year because of the crisis in the eurozone, and that has had two effects for agriculture. Our exports of food into the UK are more competitive when they're purchased in sterling prices, and this is very important because 40% of our food exports go to the British market. In terms of oil prices, they've been falling throughout the year, driven by, I suppose, a global recession in general and more production of oil in the oil-producing countries. And that means that cost of production on farms has fallen in terms of lower diesel prices. The other side of that, however, is that countries that produce oil have had a depressed demand for food products. So we sell quite a lot of milk powder to the Middle East, and demand has been dampened there because of the oil prices. Looking at what's happened in Ireland over the last 12 months, it's been a very good year. The ESRI released their quarterly economic commentary recently, and they've revised upwards again their estimate for GDP to about 6%. But really, when we're looking at the agri-food sector, it's what's happening in our export economies that's more important. So the UK and the US have done quite well over the last 12 months, and that's the outlook for the next year. Things have been much weaker in the eurozone in terms of their demand for food, and again, that's the outlook for the next 12 months. We have an embargo on trade with Russia right through 2015 and expected to continue into 2016, so that's having a negative impact on commodity trade. And then also the Chinese economy has not performed as well as everybody thought it would either this year, and the forecasts for next year have been revised. So that's all putting downward pressure on commodity prices. And I suppose the other big unknown at the moment is the political unrest across Europe and across the world, what that might mean for trading relations between countries, what it might mean for economic development in developing countries, all remains to be seen, and it's a big unknown on the agenda. So my colleagues looked at the outlook for the various sectors and to bring that together to a farm income story. On a typical dairy farm, there's both a dairy and a cattle enterprise. So this year the dairy enterprise didn't do very well. It was down over 30%. The cattle enterprise did a little bit better. When you bring the two of those together, overall we're seeing dairy farm income down 30% this year. So the average dairy farm income last year was about 68,000, closer to 48,000 this year. Across the dry stock sectors, we've seen increases in both cattle and sheep farms. This year, they sound like quite big percentages in the order of 20 or 30%, but we have to remember they're coming off a very low base. So we're looking at average incomes of around 15,000 euros for the two cattle farm sectors this year. In tillage farms, very little movement really, both this year and looking ahead to next year. So overall, when we put those sectors together, we've had an interesting outcome this year. We're expecting average farm income to fall this year by 9% to 24,000. So even in a year where cattle, sheep and tillage farms saw increases in their income, average sector income is still down, and that just shows how important the dairy sector is to Irish farming. A fall off in dairy has reduced the whole sector. What we're expecting next year is, following from the recovery in the dairy market, is for average dairy farm income to increase again next year by about 5% to about 25,000 euros.